I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for joining me online today. It's always great to see you.
It's great to see you, Charlotte, and best wishes for 2023.
Yes, Happy New Year. We have, I think, a lot of things to talk about today. We're going to look back at 2022 a little bit, but forward to 2023 as well. And where I thought we could begin, I was watching one of your recent videos, and you referred to 2022 as the year of unraveling and 2023 as the year of transition. So I wanted to start with that unraveling theme for 2022 and ask you what you mean by that. What were the things that we saw unravel in the last 12 months?
Yeah, well, there are a number of things. First off, the international political situation unraveled with the Russian invasion of Ukraine and the growing bifurcation of China away from the United States, North America, and Europe and Japan and East Asia. So I think you had some unraveling of the post-war political structure, or the post-Cold War political structure. You had an unraveling of this extended period of time of low interest rates, where you started to see interest rates in the United States and in other countries start to rise in reaction to inflation. So you started to see an unraveling of this really decades-long low interest rate of monetary policy. The fiscal problems in the United States and the rest of the world continued, and probably just grew worse. But you saw actually some unraveling of the inflation meme. There were people who in early 2022 were saying this 9% inflation is going to 90% or whatever. And instead it went to 6%. So you started to see the inflation story unwind. In the precious metals markets, you saw some of the bullishness start to unwind because the prices didn't continue to be strong. And even though inflation was high, gold and silver prices actually moved lower for much of the year. Silver actually closed about 3% higher than it had closed 2021. Gold was off 0.1%. But, so you had an unraveling of some of the conspiracy theories, and the world's running out of silver, and COMEX silver inventory is going to zero, will drive the price high. A lot of those misrepresentations that had stimulated investment demand in 2021 unraveled in 2022. So a lot of unraveling.
Definitely a lot of unraveling. You touched on, I think, a lot of big themes there, lots of things coming undone, sounds like coming to an end. So if we look forward to 2023, this is the transition year, in your opinion. What exactly do you mean by that? What are some of the big transitions we'll be seeing?
So to stay with the metaphor, we've got a whole lot of loose threads on the floor, and now we get to pick them up and weave them back into something new. So I think that what we're seeing is, having had a lot of things come unstuck in 2021, we will now be in a transition. We're going to be in a transition to a higher interest rate environment, not sharply higher interest rate environment, but a higher interest rate environment, sort of similar to what we saw in the period, say, from 1994 to 2008, rather than the period 2010 to 2021. You'll see the inflation continue to moderate as we transition to something that is not the hyper low inflation period that we saw from 1984 through 2020, but it's also not the hyper or the high inflation world that we saw in the 1970s, nor is it the high inflation area that we saw in 2021. A lot of the cyclical inflationary pressures are coming off, but there are certain secular pressures or long-term inflationary pressures that have to be dealt with. And then there are certain issues like labor, which are very confounding right now, because if you go back prior to 2021, you had on a global basis, as well as in most countries, surplus labor, and you were moving toward worse surplus labor situations. And with a number of mostly white males dropping out of the workforce, coupled with immigration policies in the United States and other countries that have reduced the availability of immigrant workers that the economy is dependent on, you're moving toward a new transition in terms of inflation and in terms of overall economic conditions. In the precious metals markets, while we saw a lot of investors back away from gold and silver last year because they weren't performing the way they had thought they would, a lot of other investors remain very much interested in, and in fact, in the first week and a half of 2023, we've seen increased interest in precious metals on the part of institutional investors and high net worth individuals, looking at the world in transition, all of these things that are up for redefinition and change, and saying, in an era of uncertainty and change, I think I should have more of my wealth in precious metals than I do.
Okay, I think there are a lot of paths there that we're going to follow down, but where I want to go first is to gold, because maybe we can situate where we're at there. I know after 2022, some people were disappointed, but really the most common thing I'm hearing about gold last year is, okay, compared to other parts of the market, it held up well and it really did not quite so bad. So maybe you can talk a little bit about gold in 2022 and also look forward to 2023 and how it fares in this transitionary environment.
Right. We have a chart that we use, and we used it in a video, I guess last week, where we showed that there are like 11 different asset classes, and cash represented by treasury bills was up 4.4% last year from the end of 2021 to the end of 2022. Silver was up 3%, gold was off 0.1%. And then all of the other financial assets, whether they were stocks of different kinds or stock indices of different kinds, or bonds or corporate debt or real estate, were off 11 to 22%. So gold and silver did a really good job last year of portfolio diversification and reducing the volatility of the net worth of portfolios by having gold and silver in there. That's one of the factors that we've seen. I said in the first 10 days of the year, we've seen increased interest on the part of high net worth individuals and institutional investors in gold and silver. And part of it is that they're looking at what happened in 2022 and saying, wow, these things really are valuable in a diversified portfolio. And Jeff hasn't been just blowing it, hot air for 40 years. He's been right. So we're finding that people are doing that. Now, going into 2023, you're seeing sort of a rebuilding of that interest in gold and silver. There were some people who were overly bullish in 2022. They thought the world was going to collapse, or the dollar was going to collapse, or this or that. The other thing was going to collapse, and gold was going to go to $5,000 or $10,000, and it didn't happen. In fact, it went from $2,000 down to like 1680, and now it's back up to 1880, I think, as we speak. It's interesting because I've seen some of these promoters on the internet this week saying, oh yeah, gold's going to $5,000, $10,000 because the international currency system is going to collapse, or the treasury market's going to collapse, or countries of the world are conspiring to sell their treasury bonds, all of which is nonsense. But mainstream investors are saying, no, put that nonsense aside. I can be in a church full of true believers and still think rationally. And that's what, I think you're going to see in this year. So I think that, if I'm right, and I hope I'm right, what we'll see are a lot more rational investors saying gold and silver makes sense in a diversified portfolio. I understand their loose relationship with interest rates. I understand their loose relationship with stocks and inflation and other factors. But I also understand that if I have gold and silver in my portfolio, I have a less volatile net wealth. Yeah, because stability in gold and silver will offset instability in stocks and bonds. So I think that you're going to see that. And the gold market, because you want to talk about gold, the gold market is set up to accommodate that. You know, you've seen investors buying about 25 to 30 million ounces a year over the last couple of years, and that's probably going to continue. It may rise a little bit more over the course of 2023. And, you know, we think that fourth quarter of 2023, you're going to start seeing more political and economic issues driving more investors to buy more gold, and the price will start to pick up. But I think that what you're going to see is a much more rational approach toward gold and silver on the part of investors. And the gold and silver markets are geared up to supply that metal to them, but probably not at current prices. It's probably going to take higher prices as the year progresses.
All right. And just to clarify where that interest is coming from, you see that from retail investors. Are you also seeing it on the institutional side? And if we go up the food chain, you know, central banks, how are they going to be buying gold in 2023? What do you see there?
Yeah. Okay. I don't really get involved much with retail investors. Where we're seeing it are high net worth individuals, in, family offices and institutional investors. Those are our primary markets. That's where we do most of our businesses, with larger investors and institutional investors. And that's where we're seeing this interest. So I'm glad to see that. In terms of central banks have been buying gold. They got very excited about gold in 2020 and 2021, and they were buying gold at higher prices. As 2022 progressed, there was a long period of time when the gold price had fallen, and a lot of central banks pulled back from buying. In the last 3 or 4 months of 2022, you started seeing central banks buying gold again. And the price was starting to rise. You know, the price had fallen to 1680, 1740, and central banks that had pulled back from buying because the price was declining said, okay, this is probably a cyclical low. This is a low enough price. I'm going to start buying again. I don't think that the central bank demand is nearly as strong as some people would have the market believe, but it is strong. You have a number of central banks that have very small amounts of their monetary reserves in gold, and they understand the portfolio diversification perspective of value of having more of their thing. So you see central banks buying gold like China and India and Turkey. And it's not that they are wholesale abandoning the dollar or the euro. I mean, you know, in each of those instances, the amount of gold that they own in terms of the percentage of their monetary reserves is less than 5%. You know, it's definitely less than 10%. So Russia's a special case because it's been a pariah state for 20 years, and it's been buying gold, and about 20% of its reserves were in gold. And insofar as most of its non-gold reserves have been frozen because they were held in offshore banks, a much larger portion of their available monetary reserves are in gold right now. But that's Russia, and that's a pariah state, and that's a special case. But if you look at these other countries like China and India, you know, they're increasing their gold holdings, but it's going from 2.4 to 3.4%. They're not wholesale abandoning currencies because they can't, but they are increasing their exposure to gold. And that's going to continue. And it's not some grand conspiracy among central banks and governments to dump the dollar. It's a matter of portfolio management.
Yeah, maybe you can tell me a little bit more about that, because we do hear all of these things about the death of the dollar. What is going on? Is it going to see a big crash there? What are your thoughts there? What is your view on the dollar as we move forward into 2023 after the strength of last year?
That relates to one of the other issues that we said we'll see in 2023. Truth will be harder to find, and the world will be much more cluttered with misinformation and bad analysis. And that's always been the case, but it's gotten a lot worse. And you've almost seen people say, oh, wow, given the developments of the last 2 or 3 years, you know, we are free to just say whatever we want. about 60% of the foreign exchange reserves held by central banks are in US dollars. To move away from the US dollar in a rapid basis is virtually impossible because you'd have to have massive increases in liquidity in other assets. If you want to move into gold, it's gold, but the euro and everything else. And that would have hyperinflationary consequences for those countries that issue those currencies or for gold. Yeah, so the gold bugs who really don't think too straight say, oh, well, when central banks start buying gold, the price of gold is going to go from, $1,800 to $10,000. Right, at which point they stop buying gold, because there's a price elasticity. And if you look at it, it's interesting because the value of gold, then, the same is true on the private sector, non-central bank level too. And if you look at the amount of gold that was accumulated by central banks and by private investors over the last 20 years of this extended bull market that really started in 2020, 2021. If you look at the value of the gold that has been accumulated, the vast majority, more than half of the increase in the value has been due to price appreciation rather than purchasing new physical gold. There has been a historic amount of gold, more than 400 million ounces, I believe now, that has been bought over the last 22 years by investors. And that has increased the value of their gold holdings. But the value of their gold holdings have increased even more because the gold price went from $250 in 2000 to $2,000 or $1,800 or $1,880 now. So that is a natural break on the market. And people don't seem to understand that. So they think that there could be this wholesale move. Central bankers do. They know that they can increase their euros and their yens and their Swiss franc holdings somewhat and slowly but surely reduce their exposure to the price, to the dollar. And they know they can add their gold to their portfolios slowly and reduce their exposure to the dollar, but they also know they can't move quickly. I was telling some people the other day, we were working with a major central bank in 1981, 1982 on a very large long-term study about making their currency convertible and about getting them out. Part and parcel of moving toward convertibility of their currency was to cease having the central bank be the national market maker for gold and silver. If you bought or sold gold and silver in that country, as was the case in a lot of other countries, you had to go through an agency of the central bank. And the central bank was the buyer and seller of last resort, and it paid a discount to the international price if it was buying it, and it charged a premium to the international price if it was selling it. So the market was less efficient than it should have been. And I was a young man at the time doing this work for the central bank, and they said, Mr. Christian, don't get so excited because this is something that's going to take many decades to develop and transpire. And in fact, 20 years later, they got out of the national market making business for gold and silver, and their currency is still not convertible. So central banks have a very long view, and they would love to see the world move to a multipolar international currency regime, but they're fully aware that that's going to take many decades. And in the next several decades, you actually have the capacity, if the US had a political system that worked, to reverse the distaste for the US dollar. So it is not for a foregone conclusion that the dollar will cease to be the de facto currency, reserve currency of choice over the long run. And even if it does, even if we do succeed in moving to a multi-currency reserve currency system, it's going to take many decades to happen.
And sorry, this is going a little bit off track here, but I wonder how you see central bank digital currencies fitting into that picture, because that's becoming more of a hot topic that I'm hearing a little bit more about.
Yeah, that's a topic. I was going to say one more thing about the gold, but let's just move into the digital currencies. if you look at money, currencies, mediums of exchange, they've changed through the years. And we went from physical gold and silver coins to ledger entries in the 14th century. You have gold in Amsterdam, you want to buy something in Venice, okay, fine. I will let you pay for that gold in Amsterdam, pay for that in Venice with the gold in Amsterdam, and you don't have to transfer the gold physically to Venice, so that was the case in the 14th century. And then we moved to bills and paper bills, and paper bills had existed, in I guess the 15th century. You actually had loans that were demarcated with sticks, and you would put a hash mark on the stick and then cut it in half, and the lender would have one half and the borrower would have the other half. And Henry V partially financed his war against France in the 15th century with borrowed gold demarcated by sticks. So you've seen currencies change, and then it went to checks, and it went to deposits and checkbooks and checks. Then it went to exchange electronically transferred funds, and now it's going to digital currencies. So there's this centuries-long stream of changing the currency system to meet the currently available technology. And that is going to happen, and it's going to continue to happen as it has for centuries. And it has nothing to do with gold. You can talk to gold bugs and they say, oh yeah, and those digital currencies will be backed by gold, but you will not find a single central banker who says, oh, and we will back our digital currency with gold. Because they know that any currency backed by gold has to be convertible into gold. A currency that is, quote, backed by gold but not convertible into gold is an oxymoron. If you're going to back it with gold, it's got to be convertible. If it's not convertible, it's not really backed by gold, right? So they know that if they had gold currency, any currency, physical, digital, anything in between that was backed by gold, their gold reserves would disappear very quickly. As the United States currency, gold reserves fell something like 100 million ounces in 1967 and the first 4 months of 1968. So no central banker sees a future digital currency backed by gold.
Okay, and I think we've come now back around to gold. I'll let you make the point that you wanted to make about gold. And I also have another question for you, which is, what do you see as a realistic price range for gold in 2023?
I think we're probably talking about 1720 as a low, possibly in the middle part of the year, and a price closer to $2,000 toward the end of the year. We think that, the gold price will be strong in the first quarter. It'll weaken somewhat in the second and third quarters, hopefully not as much as we saw last year. And then by the fourth quarter, we think that investment demand may be rising and the gold price may be rising significantly again by the fourth quarter of this year into 2024.
Okay. And sorry, what was the point that you wanted to make? I'll let you make that now. Okay. All right. I've taken you too far off track. So moving on then, I wanted to ask about silver as well and where you may see silver going in 2023. We hear a lot about the importance of silver industrial demand, but right now we're also hearing recession concerns, even at possibly a global level in the coming year. And that I would think would weigh on that industrial demand component for silver. So what are the elements at play there?
Well, there are short-term elements and there are long-term elements. And on a short-term basis, you're seeing some recovery in the electronics industry. You're seeing increased use of electronics in automobiles and in other manufactured goods. All of that is using silver. And you use about an ounce of silver per vehicle. The auto industry, unfortunately for silver and everything else that goes into it, has been in weak condition for several years and probably is going to continue to be relatively weak this year. You are seeing an increase in electric vehicles. Perhaps another 1% of the market will shift from being petroleum-powered vehicles to being electric vehicles this year. So that will increase the use of silver, maybe 1 million ounces. It's not going to put the world on fire. Solar power continues to increase, and that will continue to use more silver. So you're seeing some strength in the demand. Obviously, if we go into a recession, that could upset the apple cart, and you could see electronics and auto sales and solar power and solar panels all decline or stop growing as strongly as they would otherwise. So that's a real risk that you have with a recession with any industrial commodity, And then silver, if you were talking about the price, you're really talking about investment demand. And there it's going to be a matter of, can you actually effectively market silver to investors who have been disappointed by the fact that silver is not $500 an ounce? And I think you can. I'm not sure that the silver market and silver industry is set up to do that, but I do think it's a real issue. That's a possibility. And that could actually strengthen the silver price.
If we see that investment demand come in?
Yes.
All right. So maybe we can talk a little bit more about recession, because specifically in the US, we have these concerns that the Fed will hike too far, cause a crash, cause a recession. You actually told us multiple times last year, I believe, that the Fed could go quite a bit further than a lot of people thought that it could. And after 7 rate hikes last year, I wonder what you see coming in terms of its path forward in the year ahead.
Yeah, the Fed, in fact, has pushed further than a lot of people thought it would or could, and we still don't have a recession. We had 2 quarters of negative growth in the first half of 2022. We had 2 quarters of relatively strong growth in the second half of 2022. We're probably going to have 2 quarters of negative growth and 2 quarters of relatively strong growth in 2023. But the Fed has already increased interest rates more than a lot of naysayers thought was possible without throwing the country into a recession. And one of the points we keep making is that we are worried about a recession, but we look at the drivers of a recession as being fundamental supply and demand trends in the real economy and fiscal policy. And monetary policy is a distant third. It's highly unlikely that monetary policy would trigger a recession. What could trigger a recession is abrupt changes in fiscal policy, which is a machine that's been broken for 40, 50 years now, and reversals in the real economy that have nothing to do with government or central banks. So we're a little bit worried about that. Our expectation is that the Fed will probably raise interest rates another 50 basis points in 2 hikes over the first quarter of this year, that it will then most likely plateau interest rates and not raise them after March into the fourth quarter, at which point you might start seeing the Fed reduce interest rates of 25 basis points once or twice in the final quarter of the year, as we slouch toward a recession stimulated by fiscal policies gone awry and real supply demand trends for both goods and services in the real economy.
Okay, I'm curious to know what you think of the Fed's timing, because we hear quite a bit, they were too late to start hiking rates. Maybe now they're going to be too late in reining them back in. How do you think they're doing when it comes to timing and tackling inflation?
Yeah, William McChesney Martin, who was he was the chair of this Fed from I think 1950 to 1971, probably the best central bank chairman we've ever had. He used to say that the Fed's job was to lean into the breeze of inflation. And this Fed, which I think has been much better than, say, the previous 2 Feds, failed to lean into the breeze. And they let the breeze turn into a stronger wind, before they started leaning into it. And they've taken criticism across the board from that for having done that. But I think that they caught on to what they were doing and what they needed to do. And I think 2022 proved that the Fed could catch up with itself and catch up with the real economy. And, as I said, you saw a very weak first half of the year, and then you had a much stronger second half of the year, even as the Fed was raising interest rates. And I think that observant, empirically driven investors would take note of that and say, okay, those people who are saying that the Fed's going to raise interest rates so high as to throw the world into a recession probably don't understand the relationship between monetary policy and real economic growth.
The other thing that I want to check in with you on is this past year, especially, we've been really focused on the Fed's impact on precious metals like gold and silver. We've been focusing on inflation, interest rates, recession, that kind of thing. Are there any other factors that you see as really important for the gold and silver markets in the upcoming year that maybe people might be forgetting about, letting fall by the wayside?
Oh, yeah. And as I said, let's just start with people have been focusing on monetary policy. And it's very funny. Politicians are like bankers. They love it when people blame others for the things that they do wrong. And I won't bore you with the details about what bankers have done in the gold and silver market, and they've allowed people to blame other people for that behavior. But politicians and fiscal policy has been the major factor driving the economy up and down. And it's been the major problem facing the economy for the last 6 years. And insofar as people want to blame the Fed for the problems that we're facing, politicians would say, yeah, blame the Fed, blame the Fed. Don't look at the fiscal balance sheets of the US government or state and local governments or other foreign governments, because they're all broken. And they've really been the cause of a lot of problems. So that's a big one. Another thing is capital formation across business. And it's very big. It's a very big negative for mining and precious metals mining, and precious metals mining in particular compared to, say, copper or aluminum, because precious metals mining tends to be a smaller capital requirement than, say, a large copper mine or a large aluminum smelter. So you have a secular breakdown between stock market activity and capital formation for business. And that has been reflected in an absence of capital flows into the mining industry. And it's going to continue to limit the capital flows into the mining industry. It has very little, it does have some things to do with the mining industry's performance, but 5 of the 6 factors behind this have nothing to do with mining per se, and everything to do with changes in the capital markets of the world. And that is going to continue to be a problem for mining, as well as for other industries and small cap companies. It's going to be much harder to finance real companies doing real things. If you have some totally nonsensical thing like FTX, a digital currency exchange, or internet stock, a la the ones that we saw being hyped in 1999, you'll be able to raise as much money from the fools as you want. But if you have a legitimate business plan with a legitimate business that's going to make crockery or Dutch ovens or stoves or components for electric vehicles or components for regular vehicles, you will find that it's very hard to raise capital, because the capital is being funneled into those nonsensical pipe dreams and into indexed funds as opposed to individual stocks.
That does not really sound very great for those precious metals miners. So can you expand on that and talk about what we could, how that will impact the mining industry?
Well, we've said for many years, our advice to a lot of mining companies has been, especially gold and silver mining companies, Historically, these companies have not attracted large institutional investors. What they have over the last 10 or 20 years, maybe, or 30 years. But historically, for the last 150 years, most gold and silver mining has been financed by smaller institutions, merchant banks, high net worth individuals, the precursor equivalents of family offices. And these are people who will study your business plan, get to know your company, and do a very thorough due diligence and say, these are people I can trust with my capital, and they have a property that's very interesting. And if I have good management and a good property, this thing should be very profitable. So I will give them the money that they need to develop that mine. And so we've been telling mining managers for decades now, focus on people like that. Family offices, high net worth individuals, smaller boutique type of institutions that will look at you and say, okay, if you can produce X, 200,000 ounces of gold at $800 an ounce, I'm much more interested in you with a $600 margin or $1,000 margin on 200,000 ounces than I would be with a company that's producing 2 million ounces of gold at $1,500 an ounce. So focus on running a highly profitable company that's A, making gold, and B, making really good profits. And you will find the capital that you need to develop that mine. As opposed to saying, I've got to build an ever bigger mining company in order to attract institutional investors who will not be interested in me anyway.
And out of curiosity, so what has the response been from mining companies that you give that advice to? Are they taking it to heart? Does it make sense to them?
If I've been saying it for 20 years, I would say in the last 2 years, they started to pay attention to it.
There you go. Okay, so we've gone pretty wide ranging in this conversation, and where I want to wrap it up is we've talked about a lot of circumstances that are coming up. It looks like it's going to be an interesting year. So for investors, precious metals investors, how should they handle this situation? What would your advice be for them?
My advice would be to do a lot of homework. This is not something that you shouldn't do any investments based on, oh, this guy at a cocktail party or somebody on the internet said something. You really should invest your time studying and understanding markets and the overall economy. It's going to be an interesting time because we are in this transition to something new, and no one really is certain how the transition is going to unfold and where it's going to lead us. So there's going to be this increased uncertainty. I would own physical gold, physical silver. I would have a selection of small and mid-sized mining companies and maybe some larger, well-run, highly profitable companies, but focusing more on the mid-tier because they're takeover targets for those people who haven't taken our advice, and the smaller growth companies that are well managed. And it all comes down to management, really, in terms of those companies. But I would also look at investing as well as hoarding gold and silver. It's good to have physical gold and silver in your portfolio and in your wealth mix, and diversifying your wealth from being denominated in your domestic currency to having some of your wealth in your domestic currency and some of your wealth in gold and silver, denominated in gold and silver. But you should also be investing, because if you look at a price chart, it goes up, it goes down. And it doesn't go down because there's a conspiracy. It goes down because it's a free market. When you see something like oil prices from 2005 to 2008 in a very small channel going upward, or the S&P from 2010 to 2020 in a very small channel steadily going upward, that's a market that has something going on that you don't want to necessarily be involved in. But if you see a market that goes up and down with seasonal patterns like gold and silver, that's a market that's responding to the fundamentals in the economic environment. And yes, gold will go up, silver will go up, but it'll also come down. And so we're advising all of our clients, yes, be long gold and silver, but also hedge those positions and take opportunities using options or forwards or futures to capitalize your gains from time to time.
And one final small question, or I think it's a small question. I think a lot of people are looking at their overall portfolio right now and what they can do with that. And of course, that's very individual. But the precious metals component for you, what range of percentage should that make up of your overall?
It really depends on who you are and how much money you have and what your financial circumstances are. You know, in general, a 5 to 10% level makes sense. You look at the economic return since 1968, 1970, and you can argue that 5% and 10% in silver makes sense. And you can argue that even larger portion in physical gold makes sense. But you know, I don't know that I would not be going over 15% or 20% at this point. At this point, you have this heightened uncertainty. So I might not necessarily go that high, but I would say that having a substantial portion of your wealth in gold, if you can afford it, and silver, always makes sense. And right now in 2023, it probably makes more sense than it has at other times in history.
Okay, I think that's a great point to end on. Thank you so much for sitting down today to go over your thoughts on what you see coming in 2023. That was great, and I think it provides a lot of clarity.
Thank you. Have a good year.
You as well. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.